The first box is the one-time purchase cost. The down payment is only the beginning. Closing costs, agent fees, legal or administrative fees, loan setup costs, appraisal, moving, basic renovation, furniture, appliances, temporary housing, and setup expenses can appear before the household has settled into a normal routine. A family that prepares only for the down payment may feel rich on signing day and cash poor 1 month later. The transition from offer to stable living should have its own cash buffer. The second box is the monthly fixed cost. The mortgage payment is usually the largest line, but it is not the only line. Add association or management fees, parking, utilities, internet, home insurance, commuting, and any lifestyle cost that changes because of the location or size of the home. A larger home may cost more to cool, clean, furnish, and maintain. A farther location may require more transport time or a second car. Loan approval tells you what a lender will allow. It does not prove the household budget remains healthy. The third box is the annual cost. Property tax, land tax where applicable, insurance renewal, equipment servicing, public repair assessments, seasonal utilities, and other periodic bills may not show up every month, but they still belong in the monthly budget. A practical method is to divide annual housing costs by 12 and reserve that amount in a housing fund. If the family waits until the bill arrives, the annual cost feels like an emergency even though it was predictable. The fourth box is repair and depreciation. Pipes, wiring, roof, windows, bathrooms, kitchen, appliances, and shared building systems all age. A new home is not maintenance-free forever, and an older home is not automatically wrong. The question is whether the likely repair timeline is included in the price decision. A property that looks cheap can become expensive if the next 5 years require major work. The holding cost map treats future repairs as expected ownership costs, not as random surprises. The fifth box is interest rate and payment stress. Many buyers estimate affordability using today's rate and today's income. A mortgage can last for decades, and the family's income, responsibilities, and market rates can change. At minimum, test 3 scenarios: higher rates, lower income, and higher family expenses. If any one scenario destroys the monthly surplus, the risk is not just the price. The loan size, amortization, cash buffer, and purchase timing may all need redesign. The sixth box is opportunity cost. Money placed into a down payment cannot simultaneously serve as emergency reserves, investments, education funds, business capital, or family care reserves. A home can provide stability, but it also makes capital less mobile. This is not an argument against ownership. It is a reminder that locked capital changes the rest of the financial plan. If income is unstable or reserves are thin, putting nearly all cash into a home can increase household risk. The seventh box is transaction cost and liquidity. A home cannot usually be sold quickly in small pieces. Selling may involve time, fees, taxes, negotiation, repairs, staging, and market conditions. If the household may change jobs, move cities, grow, care for parents, or need flexibility within a few years, the cost of exit matters. A rent versus buy comparison that ignores the possibility of moving can make ownership look safer than it is. The eighth box is the linked lifestyle cost. Location affects schools, childcare, commuting, groceries, family support, medical access, and daily routines. A cheaper home that requires a longer commute, a second car, or more paid childcare may not be truly cheaper. A more expensive home that reduces other necessary costs may be more manageable than the price suggests. The map should measure the whole living system, not only the property price. The ninth box is vacancy and income interruption. An owner-occupier may still face delayed renovation, delayed move-in, job change, illness, or family disruption. A rental property buyer also faces vacancy, tenant repairs, lower rent, and tax changes. If the plan works only with perfect salary stability or optimistic rent, the risk is understated. A conservative map asks how many months the family can carry the property if rent or income is lower than expected. The 10th box is tax and regulatory uncertainty. Property taxes, transfer taxes, rental rules, loan limits, and transaction rules vary by region and may change. This video cannot give individual tax advice, but the buyer should list each tax and fee instead of relying on vague verbal estimates. Joint ownership, gifts, inheritance, rental income, or company ownership can add legal and tax complexity. When the structure is complex, qualified professional advice is part of the cost map. The 11th box is emotional value. A home may represent stability, family identity, school continuity, or the feeling of finally settling down. That value is real. But emotional value should be written beside the cash flow trade-off instead of replacing it. If the home creates comfort but leaves no monthly flexibility, a repair bill can quickly turn comfort into pressure. A mature decision asks, how much flexibility are we willing to trade for this stability, and what safety margin remains? The 12th box is the rent versus buy comparison. Renting is not automatically throwing money away, and buying is not automatically forced saving. Rent buys use and flexibility. Mortgage principal builds equity. But interest, taxes, repairs, insurance, and transaction costs are also real costs. Compare similar locations, similar living quality, and a realistic holding period. If you compare rent only with principal repayment, you miss the cost of ownership. If you compare ownership only with rent, you may miss the value of stability. The 13th box is a household stress table. Write 4 numbers. Total housing-related monthly cost, necessary living expenses, committed premiums and debt payments, and stable monthly savings. Then test 3 shocks. Income down 20%, rates up, and 1 major repair in the same year. If the household can still live, save, and maintain reserves, the home is closer to affordable. If one shock breaks the plan, lower price, more cash, a smaller property, or delayed purchase may be safer. The 14th box is the emergency reserve. Buying should not reduce reserves to zero. Cash after closing protects the household from repair bills, job gaps, medical issues, delayed reimbursement, and moving mistakes. A reserve is not extra money. It is the wall between a housing problem and high-interest debt. If buying leaves only 1 month of cash, the family is holding a large asset with a very thin safety cushion. The 15th box is decision order. Decide the living need first, the total cost limit second, and the property third. Many buyers do the reverse. They fall in love with a home and then try to make the numbers fit. A safer order sets maximum total housing cost, minimum emergency reserve, acceptable commute, required space, and likely family events over the next few years. Then the search is limited to homes that fit the plan. It is less exciting, but it reduces buyer's remorse. The 16th box is avoiding a price growth only exit. Home prices may rise, flatten, or fall. Even when they rise over the long term, a household may not be able to sell at the desired price when it needs cash. If the plan is safe only when the price rises, the household has turned housing into a market bet. A more durable purchase is one the family can carry even if prices do not help for several years. The 17th box is a shared family decision. One person may value commute time. Another may value schools. Another may focus on investment. And another may need proximity to parents. Instead of arguing over which home feels best, put each need into 3 columns: must have, important, and optional. Then place the holding cost map beside it. The goal is not to win the argument. The goal is to find the option that balances life quality and financial resilience. Add a separate line for new build, pre-sale, or older home risk. A pre-sale purchase may involve delayed delivery, changing loan terms, rent during the waiting period, and a large setup bill at completion. An older home may involve leaks, wiring, plumbing, windows, elevators, or shared repairs soon after move-in. Neither category is automatically better. They simply have different uncertainty. The buyer should not use one simple price comparison when the cash flow timing is different. Loan to value also needs a cash buffer test. A higher loan share may protect cash before closing, but it increases monthly payments and rate sensitivity. A lower loan share may reduce payment pressure, but it can consume too much liquidity. The useful question is not which ratio sounds conservative. The useful question is how much cash remains after closing, how stable income is, and whether the next 12 months contain other large obligations. Renovations should be versioned instead of treated as one dream budget. Separate necessary safety and function work from comfort upgrades and cosmetic preferences. Wiring, waterproofing, basic storage, safe appliances, and essential repairs may belong in the first version. Design upgrades, premium materials, and optional furniture can often wait. This prevents the household from spending all flexibility before it has learned the real cost of living in the home. Income quality should influence the purchase ceiling. A household with two stable incomes can carry a different risk from a household where one income is variable, commission-based, seasonal, or tied to one employer. If the buyer uses the best year of income to justify the home, the mortgage may become fragile. Use normal income, not peak income, and decide what would happen if one income source paused for several months. The exit plan should be written in operational terms. If the family must move within 3 years, can the home be rented? Would rent cover the mortgage, fees, taxes, and maintenance? How long might a sale take? What transaction costs would be paid again? Could the family carry the home for 1 extra year if the market is weak? A sentence that says, "We can always sell," is not a plan until the numbers and timeline are visible. Other goals should stay in the map. Retirement saving, children's education, parental care, insurance, professional retraining, health expenses, and emergency reserves do not disappear after buying. If the home requires every future dollar, the family may own property while losing all planning flexibility. A sound purchase leaves some annual capacity for non-housing goals, even if the amount is smaller than before. Finally, create a cooling rule. When you find a home you love, wait long enough to fill the holding cost table before making a high-pressure decision. Missing data should be treated as missing data, not as a reason to guess optimistically. Ask for management fees, tax estimates, known repairs, renovation quotes, commute costs, and loan conditions. The cooling rule turns a sales moment back into a household decision. Time cost also belongs in the map. A longer commute is not only a transport bill. It can reduce sleep, exercise, childcare time, study time, and the ability to help family members. A location that saves time may justify part of its higher price. A location that consumes time may be more expensive than the listing suggests. Treat time as a household resource, not as a free side effect. Building level finances matter as well. Very low management fees may mean the repair fund is underfunded. High fees may be a permanent cash flow burden. Elevators, exterior walls, pipes, fire systems, shared facilities, and unresolved owner disputes can all become future assessments. Before buying, ask about the repair fund, recent meeting records, known major repairs, and pending disputes. These are ownership costs, not small administrative details. The home should also be read inside the household's asset allocation. If most net worth sits in one property, liquidity and local market risk become concentrated. The home has used value, but it may not provide cash when the household needs cash quickly. A resilient plan keeps some movable assets after purchase so the family can respond to job, health, or market changes without being forced into a bad sale.